Philip Morris International is trying to pull off, well, the ultimate corporate magic trick. For decades, that name has literally been synonymous with traditional cigarettes. But today, we're putting on our analyst hats to break down one of the most aggressive, fascinating transformations in modern business history. They are pivoting completely to a smoke-free future. So let's dive into this explainer and look right under the hood of their Q1 2026 financial data to see exactly how this pivot is reshaping their fundamental valuation. To make sense of all these numbers, we've got a clear roadmap. We're going to track the smoke-free shift, break down the Q1 earnings and specific product performance, evaluate their financial health using some classic valuation lenses, check their ESG progress, and finally, look at the future forecasts. All right, moving right into part one, the smoke-free transformation. This really isn't just some side project. It's a complete ground-up redefinition of their entire business model. And the absolute crucial metric we need to focus on is 43%. As of Q1 2026, 43% of PMI's total global net revenues came entirely from their smoke-free business. Since 2008, they've poured over $16 billion into developing these products. Looking at this through a classic Warren Buffett lens, they aren't just spending money, they are actively funding and building a brand new economic moat right before our eyes. They are rapidly approaching a massive historical tipping point. At 43% smoke-free versus 57% combustibles, they are just a few short quarters away from alternative products actually overtaking traditional cigarettes to become the absolute majority of their revenue. It's wild to see. And get this, less than a decade since its launch, their smoke-free flagship, IQOS, has hit a crazy milestone. It has actually surpassed Marlboro. Think about that. In markets where both are present, this heat-not-burn alternative is now the #1 premium nicotine brand. That is a textbook example of a company successfully cannibalizing its own legacy cash cow to secure its future growth. Okay, let's jump to section 2, the Q1 2026 earnings breakdown. Let's see how Wall Street is actually digesting this massive transition. CFO Emmanuel Babeau made it crystal clear on the earnings call. The outstanding delivery of that smoke-free segment was the main engine behind their really strong quarterly beat. It essentially shielded their bottom line, even with all the choppy macroeconomic conditions we're seeing out there. Looking at the top and bottom lines, the financial health here is incredibly robust. They beat estimates with over $10.1 billion in net revenues, and adjusted EPS grew a massive 16%. But you've got to look at that adjusted operating margin, 41.1%. That proves they possess incredible pricing power. As they transition, they aren't sacrificing profitability at all. The favorable margins from these newer products are actually expanding their bottom line. Moving on to section 3, IQOS and VEEV performance. The overall macro picture is strong, but the individual product stories, they're highly nuanced. We really need to understand this uneven landscape. IQOS heated tobacco is absolutely booming internationally, posting 11.3% volume growth. But on the flip side, VEEV nicotine pouches saw a 23.5% volume decline in the US. So why the drop? Well, it's largely due to what we call destocking, which basically means retailers are just temporarily reducing their inventory levels rather than buying more, combined with some tough flavor segment competition. Still, the ongoing structural shift here is undeniable. Legacy cigarette volumes declined 5.1%. However, smoke-free revenues surged nearly 25% to $3.8 billion, and their e-vapor product, VEEV, skyrocketed by almost 95%. Even with total overall volume dropping just slightly by 1.9%, the rich profitability of those surging smoke-free products is easily absorbing the legacy volume declines. Let's shift gears to section 4, financial ratios and health. With the stock hovering right around $182, how is the market actually valuing this evolving entity? Let's run some numbers. A forward PE of 20.77 shows analysts are expecting some really strong near-term earnings growth. But take a look at the PEG ratio of 2.05. If we apply a Peter Lynch valuation lens here, since he famously popularized the PEG ratio to measure growth at a reasonable price, a PEG over 2 suggests the market is pricing PMI's future earnings expansion at a slight premium. And honestly, that makes perfectly good sense given their successful high-margin transition. Plus, an EV to EBITDA ratio of 17.82 gives us a nice, clean look at the company's total value relative to its raw cash-generating capability. For you value and income investors out there, their capital return strategy is a solid anchor. They're offering a 3.23% dividend yield with a high 83% payout ratio. But that high payout? it's protected by a massive $8.94 billion free cash flow base. Applying a bit of Benjamin Graham's philosophy here, that 3.74% free cash flow yield provides a distinct margin of safety, especially as capital expenditures start to level off and cash generation continues to grow.
Beyond just returning capital, management is actively de-risking the balance sheet. By leveraging those strong cash flows, they're aiming to bring their net debt to adjusted EBITDA leverage down close to 2.0x by the end of 2026. They're basically building up some serious financial resilience.
All right, Section 5, Sustainability and ESG. Now, evaluating sustainability for a tobacco company is, well, it's complex, but it is absolutely critical for fundamental analysis today. It might sound totally surprising for a tobacco maker, but PMI is actually making incredible ESG strides. They recently jumped to a low-risk rating on Sustainalytics, securing the absolute #1 spot in their sub-industry. Their strategic pivot away from combustibles is having a highly quantifiable, positive impact on exactly how sustainability evaluators are rating their future. Finally, we arrive at Section 6, Forecast and Future Outlook. Where exactly do we go from here?
Well, analyst consensus is highly optimistic right now, projecting 2026 revenues to grow past $43.4 billion, with EPS jumping 11.5%. This perfectly mirrors PMI's internal guidance of 5 to 7% organic revenue growth, all supported by gross margins pushing a very lucrative 68%. The fundamental roadmap looks incredibly robust.
So as we wrap up this explainer, the critical question remains, will products like IQOS continue to completely redefine this company's future? They boast a solid dividend yield, powerful international growth, and expanding margins. But, they still have to navigate those U.S. inventory hurdles with Sign and ever-shifting global regulations. Keep a very close eye on that 43% smoke-free revenue metric, because the moment that crosses 50%, Philip Morris is literally no longer a cigarette maker. We are officially looking at a completely different next-generation growth company.